everyone. If you are currently sitting there with 15 browser tabs open, staring at a wall of financial ratio, trying to figure it out if the stock is a buy or sell, you are playing this game hard mode. For decades, this was the only way. You had to manually dig through hundreds of pages of annual report, cross-reference numbers in Excel. Hope you did not miss a tiny footnote that spelled disaster. Institutional investor and hedge fund didn't have this problem. They had armies of junior analysts doing the grunts of work for them. But today, the playing field has leveled. We are in new era with artificial intelligence allowing a single retail investor to do the work of 10-person analyst team in a fraction of the time. In this video, I'm going through these steps to give you a generic advice like ask ChatGPT which stocks are going up. They are guaranteed way to lose your money. AI model don't have a crystal ball. What they do have is the ability to process massive amount of unstructured data, text, transcript, complex legal jargon instantly. I am going to walk you through the exact 8-step AI workflow I use to screen for hidden gems, spot the red flags, and that other investor completely missed, and cut my total research time into 90%. Stick around to my 5 methods numbers. It will provide you the devil advocates prompt as well that they recently saved me from buying into the massive hype that crashed 40% just a week later. Let's start with the first method, which I call as the earning call lie detector. Most investor, if looks at earning at all, just read the press release or the CEO opening statement. That is a huge mistake. The opening statement is scripted. It is polished by the PR team and the lawyer to make everything sounds amazing. The real alpha, the real truth, and is hidden in the questionnaire session at the end of the call, where Wall Street analysts grill the management team, but nobody wants to read a 40 pages transcript. This was where AI changes the game. Here is the strategy. Go to the company's investor relationship page and download the PDF transcript of the latest transcript call and upload the file to an AI model like Cloud and ChatGPT Plus. But, and this is crucial, do not just ask for a summary. The summary will just repeat the positive spin. We need to dig it in a tension flow. We need to use a specific prompt that asks the AI to analyze the Q&A section specifically. You want it to identify any question where the management gave vague, invasive, and any unconventional answer. You want to know if there is a shift in tone. Are there super confidence in the script intro but suddenly stumbling and using word like basically, essentially, or we hope during the question and answer session? I did this recently for a popular electric vehicle company. The CEO was shouting about the growth into the intro, but when I ran to the transcript through the AI, it flags like it does 3 separate questions about gross margin compression. He changed the subject every time, and that was the massive sell signal that I would have missed if I just skimming the headline. The AI act as a sentiment analyst too, catching the hesitation that human eye grow lost over. The second method, of which I'll focus on the most boring thing yet most important document in finance, the 10K or 10,000 or you can say the annual report. Specifically, we are looking into a section called item 1A, risk factor. Legally, companies have to tell you what could kill your business. The problem is they copy and paste the same standard text year by after year. It becomes noise. We might lose customer. The economy might slow down. It was the boilerplate. As a investor, you don't care about what stayed the same. You care about what has changed. It is the red flag scanner. You you have to take the risk factor section as the last page report and the same section of this year report, and you paste both this into AI and then give it into a very specific command. Compare these two sections and ignore the standard boilerplate text and list only the new risk that was added this year and significant changes in language. Why are they worried now? It is powerful because a corporate lawyer rarely add new risk unless they are genuinely afraid of the lawsuits. If suddenly one out of the nowhere they add a paragraph about supply chain dependency on a single vendor or a regulatory scrutiny in the specific foreign market that wasn't there last year, pay attention. that is the smoke before the fire. You are effectively using AI to do a difference check on a legal documents, spotting the needle in the haystacks in the hint of the future trouble. Now let me move to the finding new ideas with the method number three, second order macro searching. Stock prices do not move in a vacuum. They move based on the macro trends, interest rates, war, commodity prices, and the technological shift. The problem is most retail investors engage in first order thinking. They think oil prices are dropping, I should buy a airline before because fuel is cheaper. And that is obvious, right? Usually the market are already priced that in. To make money, you need second order thinking. You need to find the ripple effect. I use a web connected AI like Plexity for this because it has access to real time data. I will ask it is a complex logic questions. For example, oil prices are dropping. Don't give me airline. Identify industries that have a high unhedged fuel prices or fuel prices cost and would see the most immediate margin expansion, but the currently trading at a lower valuation. Give me three specific mid-cap companies with a low debt that is fit with this criteria. Suddenly, the AI might surface a packaging company that uses petroleum-based plastic, or a logic film you have never heard of. This allow you to find you the pick and solve play, and the downstream beneficiaries at the algorithm-driven news cycle haven't pumped up yet. You are using the AI to connect the dots between the global events and the specific stock trigger. Method three is done. So now we are moving to method four is about visualization. Warren Buffett always talk about buying companies with a moat and a durable competitive advantage, but a moat is just a metaphor. How do you actually prove a company has one? You prove it with the data, specifically by looking at the margin over time. If a company has a moat, you can raise prices without losing customer, which preserves their margin. I used to visualize this instantly. Let's say I am analyzing a chip company like AMD versus its competitor. I will ask the AI create a table comparing the gross margin and R&D as a percentage of revenue and net income margin of AMD, Nvidia, or Intel for the last 5 years. Format it so I can paste it into Excel. In second, it can get a clean table. You can visually see the story. Is Nvidia margin line going up while Intel is crashing down? The gap between the lines is the moat. You don't need to $20,000 Bloomberg terminal to see these trends. You just need to know which data point prove the competitive advantage and ask the AI to retrieve them. It turned abstract concept into the hard evidence. Now we get into the most important psychological tool in the entire list, which is method 5, the devil advocate stimulation, which I talked about at the beginning of the video. This is the techniques that saves our portfolio from our own stupidity. We all suffer from confirmation bias. When we find a stock we like, maybe we use the product and we saw a YouTube hype it up. You inherently look for a reason to buy. You ignore the bad news and you get married to the ideas. Once you decide I like a stock, before I put a single dollar into it, I force the AI to roast it. I tell it, act as a ruthless short seller from a hedge fund. I am pitching this stock as a buy. Your job is to destroy my thesis. Give me 5 detailed reasons why this stock could drop 50% in the next 12 months, and focus significantly on the valuation concern, competitive threats, and potential accounting irregularities. You have to tell the AI to be ruthless, otherwise it will be too polite. When I do this, it often bring up points I hadn't considered. It might say competitor X is releasing a cheaper product next month, or the debt maturity is 2026 is risky. If the AI comes up with a risk you hadn't thought of and you don't have a good counter argument for it, you absolutely should not buy the stock. This simple step act as a circuit breaker for FOMO, so which is fear of missing out. Method 6, which I want to focus, is jargon buster. This is for when you are deep in the web of financial reports. Sometimes companies use complex accounting jargon intentionally to hide bad news. They bury the bodies of the footnotes, and you will see terms like goodwill impairment, revenue recognition changes, off balance sheet arrangement. If you are not a CPA, your eyes glaze over and you skip it, and that is what they want it to be. Instead, take a screenshot of confusing footnote and legal paragraph and paste it into the AI. Then ask, explain this footnote to me like I am a 12-year-old. What is the actual impact on the company cash? Is this a one-time charge, or is this a recurring problem that is eating their profit? These levels are playing field. It translates corporate sneaks into a plain English. I once found a company that was claiming they were profitable, but the footnote revealed that their profit was entirely coming from the selling of asset, not from selling their actual product. The AI clarified and confirmed that in 10 seconds, and it saved me from investing in the dying business. Moving to seventh method, which is qualitative team screening. Traditional stock screener, one you use in Yahoo Finance or brokerage app, are based on number. You filter for the PE ratio under 15 and or dividend yield over 3%. That is fine, but it is backward looking. The biggest gain often comes from the thematic investing in the future concept, for the number reflects it. AI allow you to screen from concept. I use tools like Magnify and simply a web connected AI like Gemini or Flexity to run semantic searches. I might ask, find me stock involved in the nuclear energy supply chain, but specifically focus on the small modular reactor SMRs, which filter for companies that have actual government contracts pending and not just concept. You literally cannot do that as a traditional number-based screener. AI understand the relationship between the word. It understands the SMR is related to nuclear, and it can score news release from government contract. And this helps you build a watch list based on the thesis and the narrative, and allowing you to position yourself in the sector before the rest of the market catches to the earning growth. Finally, the method number 8, the valuation sanity check. Never ever buy a stock without knowing what the price you are paying. You don't need to build a complex discounted cash flow model with the thousands rows in the Excel, but you need a sanity check. You need to know what the market is expecting. I feel AI, the analyst growth estimate. I say to the AI model, like, analysts expect company X to grow 15% per year for the next 5 years. The PE ratio is 40. If the growth slows to 10%, what happens to the valuation? Create a sensitivity analysis table showing share prices potential at 10%, 15%, and 20% growth rate. This gives you a matrix of outcome. It tells you the risk reward ratio. If you see that the stock needs to grow 25% every single year just to justify today's price, the stock is priced for perfection. Any slip up, any bad quarter, any stock crashes, but if you see the stock is priced at as if it is never grown again, it will never grow again, but you think it will grow, that is a margin of safety. AI does the math of you instantly if you can focus on the judgment call. So these are the 8 methods: the earning call, lie detector, red flag scanner, second order thinking, mode visualization, devil advocates, jargon buster, thematic screening, and the valuation sanity check. Here is the bottom line: AI is a superpower, but it is a co-pilot, not a pilot. It finds the data, it summarizes the text, it checks your blind spot, it handles your emotions so you can focus on the decision making. But at the end of the day, you are one pressing the buy button. You are the one taking the risk. So use this tool to become a more informed, more skeptical, more efficient investor, not to outsource your thinking entirely. Thank you.